Welcome to OpenECRI's Trader Training. My name is Toby Gennaro. What I'll be talking about today is indicator divergence and how this indicator signal helps us determine if a trend is weakening and about ready to reverse. So let's take a look. When we talk about this indicator divergence, what we're saying is that at this point of divergence, the trend is losing momentum and there is a high probability of a trend change, a pullback, or a reversal depending on what time frame the divergence sets up on. Since we're looking for the highest probability setups with our trade strategies, we want to trade a trend as long as the indicators are not diverging. This divergence signal then will keep us out of trades, which is good because it helps us to weed out the low probability setups that do occur in the market. So if you find a perfect flat level trade setting up, such as our momentum breakout strategy, but the indicators look like they will diverge on the breakout, you should avoid taking that trade. Remember, we're only interested in trading the highest probability setups. This is what bullish divergence will look like on your charts. In the anatomy example, we can see that as price continues to make lower highs and lower lows, we can see that the indicator is doing just the opposite. It's beginning to make higher lows and higher highs. So all we're doing here is making a direct comparison between the extremes in price, the lows, and the extremes in the indicator. Now when we connect the extremes in both price and indicator trends, we can clearly see that the trend lines are diverging or directly opposing each other. As price continues lower in this example on the right, price reaches a point at a lower low, while the indicators are clearly making a higher low. And you can now see how this mirrors the anatomy example on the left. So divergence is being used here as a leading indicator that is predicting a trend change. After this divergence sets up, now you can see the price action making its first higher low and then followed by a higher high, which signals us to the actual trend change. This doesn't mean that we are trading the new trend, it's just signaling us to stop shorting the downtrend for now. An example here of bearish divergence. In this chart example, we can see clearly that price is trending up and it puts in a higher high with a large candle there at the top and some overextension from the moving averages, along with a lower high on the indicators and a diverging chart structure. So this is a good example of where we'd be trading with the higher trend and looking at this opposing signal to take our final profit. Even though we are anticipating a pullback or a trend change, we're not trading this trend change from the short side since we are trading strong trends only with these two strategies. So there's no need to trade reversals or pick tops and bottoms to make money in the markets. We're just looking to trade with strong trending price action. So remember, indicator divergence is just one ingredient in the overall trading strategy, and one reason is never enough to take us into or out of a trade. So if you're interested in learning more about trading strategies, check out the OpenECRI website under Education and look for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.